Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 a.m. UAE time on the 5th of April, and Brent crude oil is trading this morning in Asia firmly above $90 a barrel, where it closed yesterday. It's just on upward. It's 91.13 on Brent. And clearly this breakout from the first quarter stood doldrums is well underway and started a few weeks ago before the end of the quarter. Malia Bengali, founder of MB Commodity Corner, what's on your horizon that stops this rocket going to 100?
Thank you, Sean, for having us. Very interesting times. So the market, I think we need to understand the theme that's pointing to right now. We've always been one of stagflation. We spoke about that a few months ago. I think inflation is coming a lot higher than the market would like, the Fed would like. And I think with the oil markets being exceptionally tight because of OPEC keeping production on the sidelines, that inflation backdrop has been playing out. You're seeing sort of commodities getting bid up at the cost of equities. And I think the dilemma in the Fed right now with the Fed and the market is that they cannot cut rates, even though they desperately need to cut rates to save the banking system. Inflation is too high. And I think the oil market, it's quite interesting because, we're going through a refinery maintenance season, going into summer driving season. Oil markets are very tight based on refining outages, but it depends on the demand outlook. Like Chinese demand has been strong the first 2 months. So it's not clear sailing, but I think higher for longer is going to help, and OPEC is obviously enjoying that. But the macro is a lot more risky right now in terms of what the inflation backdrop is in the US and the Fed interest rate policy, because they probably can't cut rates.
Rachel Ziemba, adjunct fellow, Center for a New American Security, senior advisor at the Horizon Engage. Rachel, how much of this breakout price, which now at 91, we were kind of stuck in, high 70s, low 80s for much of the first quarter. We're nearly $10 above that now on Brent. How much of this breakout is geopolitical risk premium versus the good old-fashioned fundamentals?
Well, I think that there's a big chunk of the move, in my view, was about fundamentals, the sort of ones that Ilya just highlighted, the sort of OPEC plus side. And I would really point some attention to Russia, right? The concerns in the market about, it's particularly a refined fuel story, right? There's not been as much on the side of sort of the crude oil, but these sort of question marks about how much both the sanctions enforcement, but also this question mark about the impact of the Ukrainian drones on Russian export capacity, to the extent that they're adding strain there. And then I think you have the backdrop of question marks about what's going on in the Middle East. I mean, some of the move up yesterday looked to be in the times of what turned out perhaps to be fake news around both the sort of this fake rumor about the UAE and Israel, whether Iran would be striking, Israel. So I think the market is quite jittery, and maybe that's a geopolitical risk premium. But I think some of it is about fundamentals that are geopolitically linked in this context, and it's pushed the market to look back at the impact of the OPEC, of OPEC cuts, right? Which I think maybe they were a little bit, sort of uneasy about. They weren't sort of pointing towards, and look, we'll see. I mean, I think I have my concerns about how strong demand is. And China is really the factor I'm watching. And I think Millie is right. We heard earlier today, or I guess yesterday now. I'm still in yesterday.
You're still in yesterday.
I'm still in yesterday. In San Francisco today. But we heard Neil Kashkari saying, maybe there isn't going to be space to cut. And so I may not be quite as concerned about the collapse and the strains in the U.S. banking system as Malia's, but I do think this element of the U.S. growing enough, but and not so, and growing enough, but sort of not getting this this sort of risk appetite benefit of Fed cutting. And I think this is a tricky situation as we head towards the election, as we head towards the second half, where things are tightening.
Daniel Rahmat, Senior Energy Security Consultant based out of Tehran. Daniel, clearly there's many sort of pillars to this elevating oil price, but one of them, of course, is the regional geopolitical stress. And we've talked about it on a number of occasions. And each time we have you back on the podcast, it seems things are sort of ratcheting up another level, although the scale of the ratchet up is the question. Events in Syria where Israel attacked the Iranian embassy. There was very definitive declarations from Tehran that plans to retaliate. Your thoughts, does this action, does this moment finally trigger this regional, it seemed some reporting that this was finally the red line being crossed. Your thoughts on how this may or may not escalate and be a regional problem?
Hi, Sean. Thank you very much for having me here again. Yes, maybe you remember that last time we discussed that there is a theory here among the analysts that probably one of the reasons behind the October 7th attack, the so-called the storm of Al-Aqsa there in Gaza, was sort of actually security or intelligence agency's conclusion that Israel will definitely attack Iranian nuclear facilities sooner or later. So they decided to launch an attack there to prolong everything for Israel, to keep them involved or busy with conflicts and wars with Gaza, maybe with Yemen, maybe with Syria, maybe with Lebanon later. So they cannot facilitate to attack Iran. Every day, I think that this theory is closer to reality. You know, when Israel attacks an Iranian diplomatic mission and targets very high-level, actually high-profile generals, IRGC generals there, who was in practice the commander-in-chief of the whole IRGC in Iraq and Syria and Lebanon, that is a sort of attempt by Israel to push Iran for entering the war. Actually, Israel is not very happy to see that Iran is standing on the safe side, smoking its cigarettes and drinking its actually tea, watching the scene in Gaza, Israel, Lebanon, everywhere. So they're trying to encourage Iran for a retaliation that would trigger the war between the two countries. Of course, you know that Israel is equipped with very sophisticated military weapons, including F-35 fighters, other types of missiles, and very, very sophisticated, actually, air defense system. That's what Iran lacks. You know, Iran cannot be ensured that if there is a sort of all-out war between the two countries, of course, we know that the all-out war between the two countries will not happen on the ground, and that will be in the space and in the air. In this occasion, of course, Israel has the upper hand. The second important thing is Israel is an atomic power, and Iran is not, at least officially, not an atomic power yet. And the number of the atomic bombs Israel has already is very high comparing with what Iran could have purchased maybe after the Soviet Union's collapse. This is something people sometimes say, that maybe Iran has already purchased one, maybe 2-3 decades ago. But anyway, apart from these rumors, Iran is not an atomic power and Israel is. So in a sort of ballistic missile war between the two countries, at the end, Israel can target Tehran or any other city with an atomic bomb. So Iran hesitates entering such kind of wars with Israel, of course. Maybe there is a retaliation. I'm not sure. I'm not sure about it, but maybe there is one. But I don't believe that Iran would do that in a way that Israel will take the advantage to retaliate or to start a war with Iran in a higher scale. Because the war in Gaza, of course, is very, very bitter for Iranian officials because they had spent, apart from the humanitarian costs of Gaza, Iran has spent 4 decades for growing Hamas and for the Islamic Jihad and making a reliable proxy there, and that part actually forms the south front for IRGC against Israel. But Apart from that, at the moment, Israel has lost its moral legitimacy. Israel has lost a part of its military capacity there, not because of the military losses, because of the involvement in the security issues there. If they want to escalate things, they need to get engaged with the Syrian military, as well as Yemeni Houthis, and also with the Lebanese and maybe others.
So you think ultimately that even with this event, the Iranians will be very cautious about anything that resembles escalation?
They should be so.
Yeah.
They should be so. If they, you know, there is some news that Iran has sent messages to the US has sent messages to Iran that do not attack our bases, and Iran has said, okay, if we enter any clash with Israel, you stay away from that. But these are just words. You know, America is not going to leave Israel alone in a war that probably is liable to be defeated. So if Iran makes a mistake with entering Israel a sort of war, Israel will very easily target Iranian gas facilities. You know, 2 months ago we had an explosion in the gas pipeline.
It's a very precarious situation, and you would imagine retaliation would probably be, as you say, in a way that doesn't cross any Rubicon. Malia, I wanted to get back to this idea of the intersection point, the nexus between interest rates, Fed cuts, you know, as the year goes on, a bit like when we went up the mountain of interest rate cuts, the Fed and the markets got it all wrong. And on the downside, it seems the same is happening. We started the year with forecasting 7 cuts from the markets. Now we're down to 2 or 3, and they're even fading. The unemployment numbers are looking, we've got non-farm payrolls out today, another indicator, the direction of travel for inflation, oil above 90. Where do you see these things intersecting, the nexus of what they will look like for policy in the second half of the year? Sorry, I think we have silence from Malia. We have a frozen screen, maybe. Rachel, I'll take that same question to you then. Obviously, sitting in San Francisco, one of the centers of the Fed there, but that intersection, that nexus as to where they go, the cards seem to be increasingly being removed from that cut trajectory of the rate cuts.
You're absolutely right. So interestingly enough, the Fed, I'm sorry, there you are. There's a bit of technical difficulties myself.
Yes.
I'm sorry.
Please.
So interestingly, just to go back a step, so interesting, starting to the year, the market expected 6 to 7 rate cuts. The Fed in December pivoted preemptively, and they went from a hawkish pivot to a dovish pivot. I think the Fed is pretty much chasing the bond market. They're pretty much behind the curve. They've always been leading themselves into the data and putting themselves into a trap door. Now they're pretty much said to the market they're going to cut. I think the data is coming against them, and they box themselves into a corner. So this is a very tricky situation because the market expects a May cut by May or June. If they don't cut by then, it's too late into an election year. Having said that, I think the data coming out today is going to be very important. The labor market's been very strong. Unemployment is less than 4%. GDP is at 2.5%. Inflation at 3%. Why does the Fed need to cut? This is a very important question, right? Because the U.S. interest expense is $1.2 trillion. The Fed's paying more money in interest costs than actually defense spending or Medicare costs. So, but if it does that, inflation is going to go through the roof because China is stabilizing right now. So we think right now, this reminds us of the point where the market's stagflationary. The Fed will have to not cut rates. It's going to sacrifice probably the banking sector and inject liquidity through the back door. We will see how that plays out, but the Fed cannot let the genie come out of the bottle for the inflation side. That is a no-go. And the
what does the I mean, we'd again yet another record yesterday in the gold price up above $2,300. What is that telling you about the Fed outlook?
So the gold market, silver market, Bitcoin is exactly what it did in 2008. They know a crisis is ongoing and the Fed will have to cut, eventually save, they go print more dollars. The solution to the US debt problem is to print more debt. Whether it happens today or the next 6 months, the gold markets figured it out. Something is wrong. In 2008, we remember before Lehman Brothers collapsed, 1 month earlier, gold price went up and bond price went up. Risk assets went down. So the gold market knows something is not right because yields have actually been going up. So the gold market should not be doing well. And we trust the gold market. Eventually, the solution is to print more paper, and that's why Bitcoin and all these sort of assets are actually trading higher because they know the eventual solution. So it's a very tricky situation right now, but our models have been talking about GDP slowing down. The Fed cannot keep this rate up. They have to have more debt issuance. We're seeing a slowdown and higher inflation. And that's not a good environment for bonds nor equities, other than commodities. Commodities probably will do really well. And that is the backdrop for this year.
Rachel, just taking that theme and moving it into with the sort of added inclusion of the US election coming, how that complicates or doesn't. Obviously, we've got gasoline at the pump moving up higher than it was this time last year and up above $3.50. The Fed taking a move to cut rates when all macro numbers are in a typical place where you wouldn't cut rates. Trump will jump all over that as an election bias to the existing administration. Where do the politics and the economics of all this intersect as we go really deeper into an election cycle?
Yeah, well, it's hard to predict exactly how Trump will jump on it. He would probably also say that if he were president, they would be doing even more, sort of cuts.
Well, he's already signaled that a move by the Fed in an election cycle when the macro numbers you're still fighting inflation, employment is full. It would be a politically dangerous move, I would think.
I think it would, and that's why I think it does come back to the data and especially the labor market data. Now, I spent some time over the last few months reading the Conservative Republican Manifesto published by the Heritage Foundation, and one of their arguments in their Fed chapter, this doesn't mean policy that would happen after the election, but is that the dual mandate should go away and it shouldn't be about employment. But that's things we can debate in 2025 or 2026. So hopefully we'll be on the podcast talking about that. So look, I think what's happening right now with the U.S. economy is, yes, things are slowing down, but the labor market's still tight. A lot of that has to do with U.S. industrial policy. It has to do with construction, some of that tightness. Some of those factories that are being built, we saw sort of, the chips factories in Arizona are now sort of back online. I do think this is an environment, there's not a lot of space for the Fed to cut. It's tricky this year, but if there is a slowdown in employment and signs of disinflation, I disagree with the market view that if they don't cut by mid-year, they can't cut. But ultimately, I think the problem just is you have a stickiness of inflation, and even more than the Fed, I think that this oil price story is something that the campaign and the politicians really care about. They believe, and they're probably right, but they believe that consumers, that voters really care disproportionately about the pump price. I think they have to be careful and watch other food prices and other things like that. Healthcare costs are one of the largest drivers of inflation right now, actually, in the United States, and other sort of insurance costs. But ultimately, I think we are in this point where the risk is maybe not so much the Fed, but that the U.S. government starts to sort of, really worry about where those additional barrels are coming from. We saw a bit of market chatter about the decision to sort of cancel the planned refilling of the Strategic Petroleum Reserve earlier this week. I think that was a rational move at these prices. This is not the kind of price point to sort of refill.
It seemed like a very strange comment by the Energy Secretary at CERAWeek a few weeks ago to even say that they were going to be filling SPR, and prices were already well above 85 at the time, or on WTI, maybe not quite, but they were well above their target price that they had identified before.
Yeah, you almost wonder if that was sort of a talking point in a speech that had been sort of prepared before that and the like. I think now that if the U.S. is really using the SPR as a two-way kind of tool, obviously doing so in a way where sort of its comfort level is different from where the Saudis and OPEC and the GCC are trying to balance the market. But if they're using it as a two-way, sort of movement of selling when sort of buying when prices are low and selling when they're higher, we're not at the selling high when we're higher yet. I think that's probably something that if we have prices over over $100, we could start to sort of have speculation
if we
in
see
that
gasoline, if we see gasoline continuing to rise and go above $4 on the average across America, I think you might see some barrels slipping out of the SPR. Daniel, I wanted to get Daniel, I wanted to get the other side of the Iran story. Of course, we talked about the geopolitics here, and that risk premium elevates the oil price. But the one that sort of counters that from a sort of price supply demand point is Iran's exports of crude oil grew by nearly 50% last year to reach a 5-year high early in the first quarter of about 1.3 million barrels per day Iranian oil exports. Where is the trajectory of travel for Iranian oil exports, at least to even maintain at that level, to grow as we move forward? That supply is critical now to the sort of overarching picture.
Yeah, and the short run, I think, and short and mid run, we are going to have increase in the Iranian output because there are some development plans in West current oil fields that they're already ongoing, and some of them have already reached production, and there are more fields that Iran is planning to develop. I'm not yet sure whether those plans will be successful because most of them have not yet reached any contract with the Russian counterparts and Russian partners they have.
When you say you expect more, I mean, from the point of view, Daniel, did you freeze? I'm not sure. Do you expect more today? I mean, this year that this growth of, we saw 50% growth last year in 23. Can we see anything comparable to that in 2024? Let's go to the survey question. Hopefully Daniel will come back. The survey question, which is looking at this point we've been discussing, Fed will have to abandon rate cuts as long as Brent stays above $90 a barrel. Agree or disagree with that? Fed will have to abandon rate cuts as long as Brent stays above $90 a barrel. Maybe Daniel will come back, but Maliha, when we look out to the financial markets and the elevation of the oil price, another factor in this window that has come with this sort of breakout, as I would call it, from the early first quarter range, has been the appetite of the paper markets coming in, the fund managers buying up back into the long position. Your thoughts on where their appetite will go as this year drifts on?
That's a really good point, Sean. All of last year, the hedge fund managers had all been trading technology stocks, right? So there's a lot of macro money that's looking to trade out of technology, which you've seen, into commodity and oil assets. So other than demand supply, we have to remember the macro flows can sort of extend prices both on the upside and downside because people are playing that reflation theme. Taking a step back, the biggest balance between OPEC and the Fed right now, because OPEC has all this production on the sidelines, but they'll be very slow to release it because obviously we know that some countries need 95+ oil to justify their future spending plans, whereas the Fed needs them to release the oil so they can actually cut interest rates. So it's a very big sort of tug of war between the two of them. The incentives are differently aligned. But yes, the real macro money has not even started coming into oil, because if people start pricing geopolitical risk premium or macro rotation, we can see oil prices get extended unless OPEC steps in. So we're in a very precarious point of view. And right now, a lot of the increase has been driven by purely refining margins. But we're seeing sort of backdrops of the refined margins not holding up here. So there is a bit of tailwind and headwind, but the macro rotation is a big point that we need to consider if the world really starts rotating capital out of equities into commodities. And we need to see what OPEC Plus does about that.
Rachel, we started our conversation earlier, pointing out that a part of this geopolitical risk premium in the oil price in recent weeks, and all of these things that sort of come together, and to parse them apart, it's hard to say, well, that piece is because of that. But ultimately, the the Ukrainian attacks on the Russian oil refining infrastructure has certainly had an impact. Now we have the House Republicans linking Ukraine aid to the sort of cancelling of the LNG ban that Biden brought in. I'm wondering, just from your thoughts, the intersection point there. I would imagine the U.S. and the West not so keen to see the Ukrainians attack Russian energy infrastructure after they've worked so hard to allow Russian energy to continue to flow while under sanctions, but flow. Your thoughts on that nexus, the politics around Ukraine, U.S. and energy into the war?
Yeah, I mean, you're completely right. You know, and U.S. officials, I think, are concerned not only because of, you know, in a sense, the whole Russia current sort of sanctions regime is about keeping the oil flowing, but paying Russia less for it, which, you know, has its own challenges. And until a few months ago, there was very little enforcement and all the things we've talked about on the podcast. I mean, I do think the last few months have been a period of more enforcement of sanctions on Russia and Iran. We had more tankers designated on Iran today, and that's something that I think is adding sort of uncertainty in some of the price blends. On the U.S. political side, you know, the Republicans are, yes, linking it to sort of energy, but these are the same people that don't actually want to, you know, sort of give more military funding to Ukraine. So I think some of it is a bit of a sort of political story. But the bottom line is, I think there is a growing, you know, sort of plurality of U.S. Representatives that want to, you know, sort of want to find other ways of funding Ukraine, of want to have loans rather than grants and the like. And so I think we knew that this year was going to be hard for that funding piece. I would think now that I would imagine when we wake up sort of tomorrow, one of the sort of narratives is going to be, well, the U.S. is going to put restrictions on aid to Israel. Now we don't want to fund Ukraine. And just to be clear, I think that the U.S. should have been conditioning this aid. If it was giving it all, it should have been doing this for a longer time, personally. But I think this sort of political cycle here in the election, you know, this is going to be sort of difficult. On the Russian infrastructure side, I think the concern the U.S. officials have, some of them, is not just the energy infrastructure, but what if there is other infrastructure attacked? What about retaliatory strikes on Ukraine itself? What about places like Kazakhstan? I think there's sort of an element that, you know, it's once the bombing starts, where does that end? But it's not something in this environment where the votes aren't there from the votes aren't there. I think it's very hard for the Ukrainians really, really need to continue their efforts, and I think that is going to add.
Ultimately,
add
I suppose the drone war, as we know in other corners of the world, is cheap and cheerful and quite effective. Daniel, I was asking you there, you had some technical difficulties with your connection. We obviously talked about the geopolitical risk premium that the Iran was participating in, but also Iranian oil exports. I wanted to get your view because, of course, they are doubled last year and to a record 1.3 million barrels a day. And I wanted to get your thoughts on where that goes this year. Can the Iranian oil exports continue to grow?
Right. Yeah, we always have internet difficulties here in Iran, so
of course.
Yeah, sorry for that. Yes, you're right. Iran's exports actually skyrocketed last year due to some agreements with Chinese and some better conditions and some actually better arrangements with the Chinese buyers. Iran's exports in some levels even reached 1.5 million barrels per day to China. But as you know, Iran has exported oil to three major destinations. The first, which has the lion's share, is China. The second is Syria. Sometimes some oil we had exported to Venezuela, which is now cut, but and some other destinations which are not significant. The volume of Iranian exports in the short run will increase because some more fresh barrels are going to come to the Iranian export basket, but that they are going to be dependent on many issues. Most importantly, the agreements between Iran and the Russian companies for developing West Karun oil fields. But apart from those agreements with Russians, Iranian domestic companies are now working on development of West Karun oil fields and some others. But in the midterm and the long term, I think we are going to have very significant difficulties, both with maintaining the level of production because of the decline of the pressure in old fields, which Iran has failed to increase the pressure or to keep the pressure. And also we have very high slope of demand in Iran in the domestic market due to very low prices and also the low technology of the domestically built cars and others. So the increasing the production and increasing the exports are two very different things in Iran. I think we are going to have very, very significant problems with keeping the level of production and exports in the future.
Malia, last word for you. I wanted to get your thoughts on where there's the result, general agreement, the Fed can't cut at these oil price levels. But Malia, where does that leave the dollar? Will we see a divergence between the European Central Bank? Obviously, Japan is already, the yen is my son came back from a school trip there recently. He said, I can't believe how cheap Japan was. Will we see where does the dollar go under these circumstances? You would imagine strengthens.
Absolutely. I think the dollar in general is going to have a rally against broader G7 currencies. But what's happening between the euro and the yen is actually, and the yuan, is two separate things. I think the ECB will probably want to cut before the Fed because they have the data that suggests they would. So you can see the dollar's trending versus the euro for sure. The yen and the yuan are in a very precarious situation because we've talked about the yen carry trade in all our newsletters. And I think the Bank of Japan needs to raise interest rates. And, you know, we know decades long, if the yen rallies against the dollar, that's actually risk off. So I think the dollar can probably weaken against the yen in a short window of time, and I think it can probably strengthen overall because the dollar has much higher to go in general in terms of a risk asset, and that's where we are right now at the cusp of seeing what the dollar, the DXY, the index does.
Well, we'll have to wrap it up there. Brent trading at 91.25, firmly above $90 at Brent. I think we'll see today a good data point to keep an eye out for is the U.S. non-farm payrolls, what they tell us about the direction of travel on the Fed policy, probably the next sort of real guidance for the end of this week. But clearly this week ends yet another week where oil is moving higher. We will be off next week because it is in this part of the world the festival of Eid, the end of Ramadan, and we wish everybody an Eid Mubarak, and we hope that it is peaceful for all of those who don't have much of it at the moment. For everybody else, we'll see you on the other side. We'll be back on Monday the 15th. All the best. Thank you very much.
Yeah.
Thank you, Sean. Bye-bye.
Thank you, Sean.
Thank you, guys.
Thank you, everybody.